When the wealthiest person in the world offers to buy a publicly traded company for an 18% premium and the stock price does not budge, that is a clear sign that we're dealing with a risk off mentality on Wall Street. A lot of people think this inflation is not just limited to food and energy. I actually believe that it is right now, and it's very transitory and will end because we are living in the YOLO, you only live once economy. Wages by the private sector are going up, not by choice, but by necessity, as they know you get what you pay for. And this is certainly the pivot point where mortgage rates and the consumer are going to meet and see if affordability is still in the cards. Welcome back to This Week in Mortgage, everybody. My name is Sam Battaglia, your mortgage broker here at Guaranteed Rate in Beverly Hills. I hope you're having a great week. Well, as I mentioned, the wealthiest person in the world offered to buy a publicly traded company last week, and the stock price did not budge. This is a clear sign of a lot of uncertainty out there, and if there's one thing stock markets don't like, it's certainly uncertainty. Looks like risk is certainly off if this event did not cause that price of that stock to go up, as it is a widely held company. And this volatility we've been dealing with lately is a clean sign of a top on the markets because they just don't know where to go. You couple in the uncertainty, it's probably a top for the markets right now. And we may get to the point where if the stock market does fall, that people will mistake the stock market for the actual economy itself. Either way, sentiment is low and confidence is low. And if the stock market breaks, those are both going to go lower. As we talk about the YOLO economy, what I mean by this is this. You only live once. We all know that saying, YOLO. Well, I've seen the price of hotels, airfare, restaurants, clothes, and designer goods. This is not sustainable, not even remotely sustainable. Some of these prices people are fetching. As we all know, we've had a huge pent-up demand over the last couple years, and a lot of people have not done many of the things that I just mentioned, and now they're getting it all out of their system. That said, this demand, which I believe is transitory because it's pent up, will subside because this consumer is getting squeezed on every which side they can right now, and there's only so much they can handle, and I bet you the consumer will throw in the towel sooner than later on paying these crazy amounts of money for hotels and planes and dinners and clothes and designer goods because, again, wage inflation is not there to keep up with this. This is pent-up demand, and I'm just imagining that the money that folks are spending on hotel rooms and restaurants and designer goods is not an endless, bottomless pit of money. And at some point, there's going to be one moment that says, hey, maybe we should slow down, look at the price of gas. So I do believe a lot of these purchases that are happening are the YOLO economy mentality. We didn't get to do it for a long time. Now we get to do it again. But again, it's not a bottomless pit of money the consumer has to spend. And this inflation is indeed transitory when you take out food and energy. And as we're looking and talking about wage inflation, which I think is one of the most important parts of the economy because that's a clear sign of people taking on careers every single day and not just jobs, we've seen a few things happen. Number one, if you look at the TV, we see a lot of commercials that are almost intertwined to sell a product and recruit an employee at the same time, which I think is very interesting. And number two, last week, a few private sector companies in different sectors for that matter raised their minimum that they're going to pay their employees to $20 an hour, which I believe is about a 33% increase off of the proposed national minimum wage, or what the minimum wage here is in California, because they do realize that you do get what you pay for. And if you want somebody to show up and to care, you've got to make it worth their time, as well as your time and money for that matter. So wage inflation, out of necessity, is going to go up because there are not enough workers to support the services and distribution of goods that a lot of these companies have. And hopefully this will be more career stuff, like I said, and not just a job. And moving on to the housing market, this is certainly the pivot point for housing affordability when it comes to the consumer. In certain cases, you're going to see a 5% mortgage behind something, and that is certainly tagging affordability. The 10-year Treasury down a little bit today. It's Wednesday, April 20th. That is down a little bit today, but it is going to test out that 3% level where we're going to see if it hits its head there and uses it as a ceiling, or if it uses it as a springboard and blows right through it, which will not do anything good when it comes to affordability and the consumer. Now, when it comes to housing prices, they couldn't be safer. Number one, we all know there was less houses built in the last 10 years than any other 10-year period since World War II. So the lack of general supply is going to certainly support housing values. And also the fact that, I'm going to talk about this 3 weeks in a row, a lot of people will not give up their mortgage that they love, that they got in the last few years, which is going to be a bigger constraint on housing that I believe we haven't even seen work through yet. And I'm going to say a quick little note here. People always ask me, well, can housing crash like it did in 2008? The answer is absolutely not. It cannot crash in 2008. Different environment, different setup. Back then, as a mortgage broker, we did not have lenders that wanted to lend money. They'd come in and out of the market. They'd go out of business. The government would take them over on Friday nights, if anybody remembers that. So we were actually dealing with no liquidity in the mortgage market. The difference now is mortgage paper is very clean. It's very liquid on the secondary market. And for that reason alone, those reasons alone, coupled with the fact that there is no inventory, we are not going to see housing come down anytime soon. And even if rates go tick a little bit higher, I still don't think we're going to see housing come down. Now, when I talk about housing, I talk about the under 2 to 3 million crowd, heavy demand, over 3, 4, 5 million crowd, like I mentioned last week. I guess you could say that at that level, beauty is in the eye of the beholder when it comes to what somebody wants to pay for a home. Well, that is my show this week. I hope everybody has a great rest of the week. If you need anything with your mortgage or anything real estate related, please don't hesitate to reach out to me. Thank you so much for watching. Have a great rest of the week.